The RBNZ held rates at 2.25% on February 18, but the NZD didn't stabilize. It crashed 1.6% against the AUD to 1.165.
Right, an immediate drop.
Yeah, and here's why your mortgage just got $90 more expensive per week despite no rate hike. Welcome to the deep dive. We're looking at the latest Reserve Bank decision, the actual market beta, and exactly what it means for your portfolio.
Because the market punished the NZD not for the hold itself, but for the MPS language. Phrases like nascent recovery and wait and see signaled capitulation.
Capitulation, so they just gave up.
Exactly. Even with rates unchanged, the 160 basis point gap remains a magnet for carry trade capital. And for you, that means the money funding your mortgage just got much more expensive.
Because when foreign capital leaves, the currency drops and wholesale borrowing costs for banks shoot up. That's your $90 a week right there.
Right. It's the dovish hold paradox. You hear hold and think your budget is safe, but the currency market hears wait and see and aggressively sells the Kiwi dollar.
And every time the Kiwi drops, importing anything from lumber to laptops costs more.
Which means businesses immediately pass that cost to you at the checkout counter.
Let's dig into that language a bit. Nascent recovery sounds almost optimistic to a regular person, right? Like things are getting better.
In a textbook, sure. But in the reality of global finance, nascent means fragile. It means weak. Institutional traders hear that and instantly bet against your currency, driving up your cost of living.
And here's what nobody's telling you. The RBNZ didn't hold to protect the economy they held because political pressure from Winston Peters left them no room to hike.
That political friction tied their hands. But the market doesn't care about Wellington politics. The market cares about yield.
And the yield is better in Australia, which hits your wallet because of that 160 basis point gap.
Exactly. It's a massive gap. If I look back at our first video, we talked about how the RBA's fire extinguisher is at 3.85% fighting inflation in Australia.
Right. They're aggressively keeping rates high.
While the RBNZ sits on its hands at 2.25%, that 160 basis point difference pulls investment capital out of New Zealand and into Australia, devaluing the money in your bank account.
We've actually seen this movie before. In our second video, we tracked the global capital flows we saw in Brazil.
That massive $26.3 billion exit?
Yeah, exactly. And now those exact same flows are accelerating into Australia via the Takichi trade.
Which is a huge factor here. Japan has 21.3 trillion yen in stimulus sloshing around. As that Takichi trade unwinds, Japanese investors are dumping cheap yen and buying high-yield Aussie dollars.
Amplifying the Australian dollar's strength.
Right, and making the Kiwi dollar look even weaker by comparison. This global spillover directly inflates the price of every tank of gas you buy.
Because we buy oil in US dollars, so a weaker Kiwis means you pay more at the pump. It's inescapable. Let's look at the hard institutional data. You brought the CFTC numbers?
I did. This confirms the 160 basis point trap we warned about in video 3. NZD is now officially a funding currency for carry trades.
Meaning hedge funds borrow cheap Kiwi dollars to buy high-yield Aussie dollars, profiting off the difference while driving your currency into the ground.
Exactly. The CFTC data shows institutional traders added 26,000 long contracts on the Australian dollar. They're betting heavily on the RBA.
And on the flip side,
they dumped the Kiwi. Short positions on the New Zealand dollar spiked by 34,900 contracts.
Wow, so 34,900 bets directly against the New Zealand economy. And when big money shorts your currency, the banks get nervous, which means they hike your retail mortgage rate to cover their own risk.
Precisely. And this creates a serious problem for Auckland homeowners. And here's why it matters to you. 68% of fixed-rate mortgages reprice in the next 12 months at these higher wholesale rates.
So even if your rate is fixed today, you are stepping onto a repricing cliff very soon. You will feel that $90 a week hit.
There's no hiding from it. The technical charts prove the damage is already done.
You're talking about that 1.18 resistance level on the AUD to NZD chart?
Yes. For months, 1.18 was a ceiling. But the RBNZ's inaction turned it into a floor, and then we just smashed right through it down to 1.165.
The real story isn't the hold, it's the breach of 1.08. That technical break confirms the market has given up on NZD recovery.
And when the market gives up, the wholesale funding markets panic. That's why your local bank is paying more for the money they lend to you.
Okay, so the damage is done, the gap widened. Let's update the scenarios. What are the actual probabilities of where your money goes from here?
We have 3 real scenarios. The most likely at a 65% probability is what we call the yield sinkhole.
The yield sinkhole, that means the RBNZ just keeps holding at 2.25%, right?
Correct. They stay passive. The AUD to NZD rate targets 1.20, and that $90 a week mortgage pressure continues indefinitely. Your cost of living just stays painfully high.
Just a slow bleed for the average household. What's the second scenario?
That's the defensive hike, sitting at a 25% probability. This is where the currency bleeds so badly that the RBNZ is forced to raise rates just to defend the Kiwi dollar.
Not because the economy's doing well, but just to stop the currency from collapsing completely. And that means a direct hit to homeowners.
A massive hit. If they are forced into that defensive hike, your mortgage spikes another $40 to $50 a week on top of the current wholesale rises.
So you're looking at potentially $140 a week in extra costs just to keep your house. Is there any good news? What's the third scenario?
Scenario 3 is the growth miracle, but it's only a 10% probability. This assumes their nascent recovery actually succeeds.
Meaning exports get cheaper, businesses sell more overseas, and wage growth finally catches up to offset these massive living costs.
Right. But a 1 in 10 chance isn't a strategy you can bank on. You have to prepare your portfolio for the yield sinkhole.
Let's break down exactly how this hits different groups. We've mentioned mortgage holders taking a $90 a week hit.
That's a $4,680 annual depreciation tax on a standard household mortgage. It's money vaporized just to service the exact same debt.
What about businesses? The importers bringing goods into the country.
It's brutal for them. There is a $1.2 billion annual cost to the import sector right now.
Let's translate that. If you own a business and import $100,000 worth of inventory, that 1.6% NZD crash means your order costs an extra $1,600.
Overnight. And businesses can't absorb that. It gets passed straight to consumers through higher prices on groceries, fuel, and electronics.
So even if you rent, you are paying this depreciation tax every time you scan an item at the supermarket?
Exactly. Now, if you're an investor, the game has completely changed. You can't just sit in New Zealand assets while yields are compressed.
Right, because inflation is eating your returns. Where is the smart money going?
They're shifting to Australian assets as a natural hedge, things like Commonwealth Bank of Australia or Westpac.
So by buying AUD assets, you actually capture that higher yield and ride the currency strength, protecting your wealth from the weak Kiwi dollar.
It's the only logical move when the institutional money is doing the exact same thing.
Okay, we need to give you the exact tools to handle this. We updated our RBNZ Decision Impact Calculator, V2.0, with real post-meeting data, the 160 basis point gap, and the NZD at 1.165.
You need to know your exact exposure. See exactly how this costs with the link in description.
And remember, former institutional strategists curate every insight. This isn't AI-generated content. It's AI-accelerated analysis with human judgment.
You don't want to guess with these numbers. Use the calculator.
All right, let's hit the actionable steps. What do people need to do today? Let's start with the mortgages.
Do not wait for the RBNZ to cut rates. The wholesale rates are dictating the terms now. Look at fixed-term extensions immediately to lock in certainty before that 25% defensive hike scenario becomes a reality.
Because if the banks panic, retail rates will shoot up regardless of the official cash rate. What about the business owners?
Hedge your currency exposure right now. Use forward exchange contracts to lock in your import costs. If you don't, you are going to eat that $1.2 billion importer's burden.
You literally can't afford to just hope the currency bounces back. And finally, for regular households.
Audit your spending on imported goods. Every 1% drop in the NZD is a secret price hike. Switch to domestic alternatives wherever you can to shield your wallet.
So cut back on the imported luxuries, focus on local. It makes a huge difference to your bottom line.
It really does. You have to take control because this central bank has clearly stepped back.
Which leaves us with a final thought for you to chew on. The RBNZ didn't just hold rates. They made a trade-off. They prioritized a fragile, nascent recovery over the value of your savings.
It's a massive gamble with your money.
It is. The real question you need to ask yourself is this. Can a recovery fueled by a crashing currency actually survive the inflation it creates?
That is the ultimate question.
Thanks for joining us on this deep dive. Check your numbers, adjust your portfolio, and we'll see you next time.